Dennis, so in the financial world, money has value, not necessarily because of the paper it's printed on or the numbers that show up in a bank account, but it's really what you can do with that money. Right. And a lot of people, similar to a pen, the pen maybe doesn't have any value. You can write with it and come up with thoughts or plans or whatnot. When people come to you, they're oftentimes looking for advice on certain aspects of finances so that they can continue to maybe live their lifestyle, to retire, to put their kids through school, right? It's not usually for just the collection of zeros at the end of the account. When you talk to people, is this kind of a path that you go down?
Well, we do. I learned a long time ago, there was an old story that Sears Roebuck one time sold 7 million quarter-inch drill bits in a year. Nobody who bought that drill bit wanted a drill bit. What they wanted was a quarter-inch hole in something. We don't do financial plans. What we do is we plan a way for people to accomplish a goal. The plan is just a mechanism to get there. Nobody wants a plan. They want to get their kids to college. They want to, buy a boat. They want to go to Hawaii or whatever they're going to do. So part of what we're doing is trying to help people recognize, first of all, where they want to go, and then try and show them the road to get there, and do it in a way that they can get behind and understand.
And so when people come to you with, let's just say, we're on the topic of pens. They make gold pens. Somebody comes to you with the topic of gold. What are you able to say to them? Because they don't really want. Well, some women do want gold. Some men, I suppose,
all
want
women
gold.
want gold. And gold and chocolate. That's the two things.
And diamonds.
Sort of universal for women.
Yeah.
Diamonds, yeah. Exactly.
But outside of that, from the investment standpoint, most people aren't thinking, man, I need bricks of gold, and that's going to,
Some are.
Okay.
There are.
Tell
a few
me more.
Out there.
Okay.
Well, the reason this comes up.
I don't know everything, Dennis.
For all of you out there who maybe don't pay attention to all this stuff as closely as I do, last week gold took an enormous hit. And there were 400 tons of gold sold between Friday and Monday's close. And, everybody would start screaming around. And gold is one of those objects. It's sort of like, gay marriage or whatever that excites enormous passions. There are two schools of thought about gold. There are the deniers. Gold is a barbarous relic. It has no value. It's useless. It's
tulips.
People who hang out with gold are just basically kooks and fools. Then there's the other side. It says that everything that happens in the world is a plot, and that gold is the only thing that will store value for you, and that you need to hold gold, and you need to have bricks of gold, and you need to have stuff. In fact, I happen to know some people who live around here who have gold coins buried in their backyard because they're convinced there's an apocalypse coming, and the only thing that's going to be left is going to be gold and diamonds.
You know what they should be doing?
What's
burying seeds that could grow plants. So when the
but then
apocalypse comes, they can have food.
Yeah. Well, they figure they're going to buy the food. These people, I can't imagine these people ever farming anything. So what happened was that when the gold started to fall, everybody who hates gold started coming out with, well, this is exactly going to happen. Everybody loves gold, so this is the time to buy it. Both the deniers and the gold bugs are right and wrong. If gold was so useless as a store of value, why does every central bank of every nation on earth own gold in multiple tons? If it's so good, how come some country doesn't set itself up on a gold standard again and make itself the paragon of financial rectitude in the world? So they're somewhere in between. But here's the thing you got to remember. Gold didn't fall all by itself. You have to look at the context. Gold fell with every other commodity, especially the industrial commodities, copper, zinc, lead, all that stuff fell at the same time. And the reason it fell is because China's economy is slowing down. And China is the biggest consumer of commodities on earth. So what the ripple effect is this. As China slows down, the countries that export to China, Australia, Brazil, Peru, Chile, those kind of places, are also going to slow down. As they slow down, their currencies will weaken and the dollar will strengthen, which is going to make the problem worse. Then you throw in the fact that the Japanese are purposely trying to weaken their currency to build up their exports and to make their economy go better. What you've got going on around the world is a very deflationary impact, and commodities do not do well in a deflationary impact. You have to have inflation. Now, one of the things that this also leads to believe is if the world is slowing down now, starting to go into an economic slowdown, what's going to happen? What's going to happen to things like real estate? Okay, chances are real estate will either plateau where it is right now, or start maybe have a little weakness. But for investors, you have to remember these contexts are very important. Why does this happen? It doesn't happen in isolation. It always links to something else, and you got to be able to put the dots together. And that's what finance and investment is all about: is putting the dots together in the correct way to come up with a conclusion.
Finding the value that's below the surface.
Exactly right, or how you can determine the value by connecting various events that look isolated.
So when you start looking at places to invest, knowing these things, are there certain places that you say, hey, because of the potential of world economic engine slowing down, right, and commodities potentially going down, and the huge consumers of these commodities going down, what do you tell people?
Well, what you start looking for is companies that generate stocks that represent companies that can generate returns in every environment. People buy food, and food gets cheaper in deflationary environments. So companies that make food make more money. Healthcare companies, regardless of how badly we try and screw the system up, they somehow figure a way to make money. There are companies like that do well. You stay away from companies that are heavily asset-based or have lots of debt, because debt becomes extremely expensive in a deflationary environment. You want to be in a low-debt situation. And the other thing you got to realize is if growth starts to slow down, the Fed is going to turn the spigots on again, and they're going to pump more money into this economy, which is going to drive interest rates down. And the U.S., regardless of how much we dislike it or whatever we might say about what goes on in this country, we've got some problems, but we're the cleanest dirty shirt in the closet. And money's going to come here by the bucket as it starts flowing from other places.
And not just money, and this is maybe a little bit of a tangent, but a lot of the people who are some of the brightest are coming here to work from all over the world. So not only is some of the money coming into America, but some of the brightest people from all over the world are coming here, and not just into the country.
Right.
I mean, into our backyard here in Seattle.
Human resources are flowing, and I mean, when you think about this, if you've got a PhD in something and you're in Egypt, you got about a better than a 40% chance of being unemployed. You come to the United States, you've only got you've got 7% chance of being unemployed. So people are coming here because they can make a lot of money. This is still the land of opportunity, as much as we might gainsay it.
Sure. Dennis Gibb joins us, president of Sweetwater Investments. Dennis, so this is, there's things that you should invest in. I still like to talk a little bit about what you said almost a year ago with Apple. And you had said, and I still remember, that if Apple continued to grow at the pace it was, it would own everything in the world.
Right.
Right?
Exactly right.
And it didn't.
It didn't. Well, companies run into a wall. The law of large numbers says it's harder to grow a $500 billion company than it is a $50 billion company. Apple got too big. It ran out of products. It ran out of innovation. The stock got over-owned. Everybody who could possibly own this stock owned it. And when growth slowed down, people said, I'm getting out of this thing, and they're still getting out of it. And they've driven the stock from 700 down to less than 400 the other day. It's back above 400 today. So, but here you got to think. A year ago, this thing was grossly overvalued. Today, if you take the cash off their balance sheet, you're buying the rest of Apple's business for a less valuation than Michael Dell's paying for his own company to take it private. In a declining PC industry, Apple is cheaper than Dell. This company would have to cut its earnings in half before it got to a market PE. It's selling at 10 times earnings for a company that's still selling a ton of junk out there. I mean, the Apple phones, iPads, all the rest of the stuff are still selling. It's not like the company went out of business. And there are going to be some new products, probably in the third quarter. They're going to start demonstrating some new products. And the guys now who are getting all the attention, Samsung and all the rest of them, they'll fade. That's the way tech fades. So the fundamentals of Apple are still good. This is the time to start doing your research and start thinking about this thing. We have a concept in the industry, it's called catching a falling knife. If you're trying to catch a falling knife and you got to rub the blade, you're going to cut yourself. So what you do with a stock is being sold like this is you just wait. It'll tell you when it's done. And when it's done is when you start nibbling away and start buying it. And if you have patience, you'll do well with a well-found company.
Yeah. Dennis, always good information. Thanks so much for joining us. But before you go, there are some other economic indicators outside of Apple and
this is a tough one to talk about on a show sponsored by Mortgage People.
Well, that's okay.
How many mortgage ads do you see here every day, Ben?
Well, they're everywhere.
Exactly. And you know the last time you heard that many mortgage ads?
About
2007, 2008.
Yeah.
So, I mean, the point is, if people are pushing this thing, be careful when everybody's jumping on the same train. It's an indicator. I don't know how predictive it is, but it's something I keep an eye on when I see people pumping everything. Just like when people were pumping gold every day, you heard 15 gold ads, and that was pretty close to the peak in the gold market.
Sure. Well, right now with mortgage rates where they are, a lot of people can save money on refinancing.
They probably can, but if they can get it.
If they can get it.
Remember, you're still having to deal with banks who are just basically criminals dressed in suits.